Welcome back, everybody, to another deep dive. Today, we're going to be looking at how many stocks should you own in your portfolio?
Mm-hmm.
We always hear that diversification is key, but is that really true?
Right.
So to help us out today, we're going to be taking a look at a video from Beavis Wealth all about Warren Buffett and how he thinks about portfolio construction.
It's a great video. Yeah.
It's a good one. So let's just dive right in.
Okay.
So, Buffett, he likes to start off with these little thought experiments kind of to get your brain going. And he starts off this video by saying, imagine somebody in your town, right? They own a few local businesses.
Yeah.
Maybe they own the bakery and they own the dry cleaner and they own a hardware store. Would you consider them diversified?
You probably would. Yeah. I mean, they've got a few different industries that they're playing in.
Yeah. And then he goes on to say, so why, when we're talking about stocks, do people feel like they need to own 30, 50, 100 different stocks?
Right. It's like somehow the logic changes when we're talking about the stock market instead of, private businesses. Yeah. And Buffett, he really believes that, this obsession with owning dozens or even hundreds of stocks, it really comes from a lack of understanding of the businesses that you're investing in.
Yeah, he actually says, and I quote, diversification is a protection against ignorance.
Right.
It makes very little sense for those who know what they're doing.
If you know what you're doing, you should be able to pick a handful of really great businesses.
And it's funny because he even goes on to say that outside of Berkshire Hathaway, he only owns one other stock.
That's wild. I mean, this is a guy who could buy, any company in the world, and he chooses to just own basically one.
So is he saying that we should all just ditch diversification and, pick one stock and just hope for the best?
No, not exactly. I mean, it's important to understand the context here. Buffett isn't saying that everyone should only own one stock. I mean, he's got decades of experience evaluating businesses and, millions and billions of dollars to put to work. But his point is, if you really understand a business, if you understand its long-term potential, a concentrated position in that business could potentially do a lot better than spreading your money across, dozens of companies that you barely know anything about.
Yeah, so it's almost like instead of diversifying across all these different companies, you should really be diversifying your time and effort into really understanding a few companies.
Yeah, I think that's a great way to put it. It's not about blind bets. It's about deep knowledge.
So it's more about quality over quantity then.
Exactly. He's looking for what he calls wonderful businesses.
Okay.
Companies that have these strong competitive advantages. They've got great management. And they've got the ability to, weather any storm that comes their way. He believes that owning a few of these exceptional companies, it's a much better path to wealth than owning a basket of, mediocre or average companies.
Yeah. Right. And it's funny, in the video, he and Charlie Munger, they even call out, a lot of the stuff that's taught in finance classes. They call it twaddle.
Yeah, they don't mince words, those two.
So what's their beef with, the traditional approach?
Well, I think their main issue is with this idea of modern portfolio theory, which is all about diversifying to minimize risk and basically get average returns.
Right.
They kind of see that as settling for mediocrity, but, who wants to be just average?
Not me.
Right, exactly.
So this all begs the question, right? Can the average investor actually identify these so-called wonderful businesses? Or does Buffett's approach require, a level of expertise that most people just don't have?
That's a great question, and it kind of leads us to the heart of the matter here. It's not just about ditching diversification. It's about understanding what makes a business truly great in the first place.
Right, and how to actually find them.
Exactly, and that's what we'll dig into next.
All right, sounds good. Let's take a quick break. We'll come back and talk about that. All right, so we're back, and we were talking about these wonderful businesses that Buffett's always going on about.
Right, yeah.
But, how do we actually find these companies? How do we know which ones are the real deal?
Well, that's where Buffett's idea of a moat comes in.
A moat?
Yeah, like a moat around a castle.
Okay.
But in this case, it's not filled with water. It's filled with, competitive advantages.
I see.
So a moat in business refers to a company's competitive advantage, what sets it apart from rivals, and allows it to consistently earn high profits.
So it's like a real moat protecting a castle. It's protecting its profits.
Exactly. You got it.
Okay. But what are some real world examples of these moats?
Sure. So think about a company like Apple, right?
Okay.
Their brand loyalty and ecosystem of products, that creates a powerful moat. People are willing to pay a premium for Apple products. And once you're kind of in their ecosystem with your phone and your laptop and your watch, it's really hard to switch.
Yeah, you're locked in.
Exactly. Or look at Amazon, right?
Okay.
Their logistical network and their Prime membership program gives them a huge advantage in e-commerce. It's hard for anyone to compete with them on speed and price.
So it's not just about finding a company that has like a cool product or service today, but it's also about thinking about whether that advantage is going to last into the future.
Yeah, you hit the nail on the head there. It's about a sustainable moat.
Mm-hmm.
Will this advantage still be relevant in 5, 10, even 20 years? That's the key question to ask yourself when you're evaluating a business.
So it's almost like we have to be like fortune tellers, like predicting the future of business.
Well, it is challenging, right? But that's what makes investing both an art and a science. You're not just looking at numbers. You're trying to understand industry trends, consumer behavior, technological advancements, all those factors that can shape the future of a business.
I'm starting to see why Buffett and Munger are so skeptical of like traditional finance theory. It's like they take a much more holistic view of investing.
Yeah, they do. They believe in deep fundamental analysis. They dig into financial statements, yes. But they also read industry reports. They study management teams. They really try to understand the soul of a company.
It's like they're business detectives.
Exactly. They want to know what makes it tick.
And this really changes how you think about being an investor. It's like you're not just buying a stock. You're becoming like a part owner of this business,
Yeah, you're not just along for the ride, hoping for the stock price to go up. You're actively engaged in understanding the business and its long-term potential.
Okay. So for someone who's maybe a little bit intimidated by all this,
Yeah.
Where do you even begin? Like, what's a good first step towards taking a more, hands-on approach to investing?
Well, I'd say start by picking a company that you're already familiar with. As a consumer, maybe it's a brand that you love or a company whose products you use every day. And then dive into their financial statements, read their annual reports, and just start piecing together the story of their business,
Okay, so make it personal.
Exactly. Yeah. Start with something that you understand and then go from there.
That's great advice. But what about those of us who still feel, more comfortable with a diversified approach? Is there like room for that in Buffett's world?
Absolutely. Even Buffett acknowledges that diversification can be a suitable strategy. For those who don't have the time or the expertise to thoroughly analyze individual businesses, things like index funds and ETFs, which track the performance of a broad market index, those can be a great way to achieve market level returns with, lower risk.
So it's not an all or nothing thing.
No, not at all.
Right.
I mean, the key takeaway here is that regardless of your approach, whether you choose to focus on a few stocks or diversify across many, you should always strive to understand what you own. Whether it's a single stock or a diversified fund, knowledge is power in investing.
Right. And that kind of brings us back to you, dear listener. We've explored these two sides of the diversification coin. We heard Buffett's argument for focused investing in, wonderful businesses. And we've also acknowledged that, diversification can still be a valid approach, particularly for those who are maybe newer to investing or have less time to dedicate to research. It's all about finding that strategy that best suits your own goals and risk tolerance and level of expertise.
Exactly. And as you continue your investing journey, always remember that learning is an ongoing process. The more you understand about, businesses and markets, the better equipped you'll be to make, informed decisions.
Well said.
Yeah.
All right, so we're going to wrap up this deep dive, but let's leave our listeners with kind of a final thought.
Okay.
How can you apply Buffett's principles to your own investment strategy? Do you need to rethink your approach to diversification? Maybe it's about deepening your understanding of the companies that you already own. Whatever your next step is, remember that, knowledge is power, and the more you learn, the more confident you'll become as an investor.
I think that's great advice. Keep exploring, keep learning, and never be afraid to challenge conventional wisdom. That's the true mark of a successful investor.
Well said. Thank you for joining us on this deep dive into the world of Warren Buffett. Till next time, happy investing. Okay, so we've talked about, what Buffett looks for in a business and why he thinks this approach is better. But how do we actually put this into practice? I mean, how do we find these these wonderful businesses.
Yeah, that's the real work begins, right?
Right.
Remember, Buffett's not just throwing darts at a board here. He's doing deep research. He's understanding the intricacies of each business that he invests in.
Hmm.
He often talks about, looking for companies with a durable competitive advantage.
Yeah.
Something that sets them apart and allows them to thrive for years to come.
So it's not about like, the hot product of the day or the flashy CEO. It's something deeper.
It's about the underlying business.
Right.
And that edge that they have, it needs to be sustainable. Is it still going to be relevant in a decade or two?
Yeah.
Think about a company like Coca-Cola.
Okay.
I mean, their brand recognition is so strong worldwide that it acts as a powerful moat.
Right. Everyone knows Coke.
Exactly.
Yeah.
People all over the world know and love their products, and that kind of loyalty is really hard to replicate.
Yeah, that's a great example. But this all sounds really time-consuming. Does that mean this is only for like professional investors or people with, tons of free time?
Not necessarily. I mean, it does require effort and a willingness to learn,
Sure.
but it's not rocket science,
Okay.
Start by picking a company that you're interested in, maybe one whose products you use or you admire. Read their annual reports, look at their financials, and try to understand what makes them tick, what makes them work.
Okay.
There's also plenty of resources online these days for investors of all levels.
That makes it a little less intimidating,
Yeah.
knowing that you don't have to be, a Wall Street wizard to do this.
Right.
But I think, let's be honest, not everyone wants to, spend their evenings poring over financial statements.
Yeah, some people just want to, relax after work.
Exactly. So for those who maybe prefer a more hands-off approach, does Buffett's philosophy still hold any value for them?
Absolutely. I mean, even if you choose to diversify, through index funds or ETFs, you can still benefit from understanding, the principles of sound investing. Look for funds that hold companies with strong fundamentals, a history of solid performance.
Right.
Don't just chase the latest trend or, hot stock tip.
So no meme stocks.
No meme stocks.
Okay, good to know.
Yeah.
So regardless of, how we approach investing, I think there's a lot we can learn from Buffett's wisdom.
Definitely.
It's about being thoughtful and intentional about where we put our money, understanding the businesses that we invest in and focusing on that long-term value creation.
And remember, investing is a journey, not a destination. It's about, continuous learning, adapting to new information, and just staying true to your investment principles.
Well said. All right. Well, that's about all the time we have for today. So as we wrap up this deep dive, I want to leave you with a final thought. How can you apply Buffett's principles to your own investment strategy? Do you need to rethink your approach to diversification? Maybe it's about deepening your understanding of the companies that you already own, whatever your next step is. Remember that knowledge is power, and the more you learn, the more confident you'll become as an investor.
Yeah, I think that's a great way to put it. Keep exploring, keep learning, and never be afraid to challenge, the conventional wisdom that's the true mark of a successful investor.
Couldn't have said it better myself.
Yeah.
Thanks for joining us on this deep dive into the world of Warren Buffett. Till next time, happy investing.